tax position. So the initial transfer into trust, 0% charges. The initial transfer into the asset allocation trust counts as a chargeable lifetime transfer, so inheritance tax is payable if the client's transfers exceed the nil rate band, which is currently $325,000, at 20% on the amount above the nil rate band being transferred. However, only assets up to the nil rate band are held on the relevant property trust with our asset allocation trust. All assets over are specifically held on a bare trust for the settlor. Those assets therefore count as belonging to them and pass under their will, not under the terms of the trust. As only the nil rate band is ever in trust, the 10-yearly charge for inheritance tax on relevant property trusts will always be at 0%. The asset allocation trust specifically carves out sufficient assets to maximise the use of the resident's nil rate band on the death of both of the clients. This ensures the maximum benefit of the nil rate bands available. Assets remain the client's assets for inheritance tax. The client retains the right to live in the house and draw money from any bonds. The transfer into the trust is known as a gift with reservation of benefit. This means the full value of the house and investments remains in their estate for inheritance tax purposes. As the client is also a beneficiary of the trust, the assets remain theirs for capital gains and income taxes. Any income or capital gain made while they are alive needs to be reported on their personal tax return. This type of trust is not for inheritance tax planning. Multiple properties into the asset allocation trust. It's possible, but seek advice. It is legally possible to transfer properties into trust that are not CGT exempt by being the principal private residence. Doing this, however, any increase in value from when it was purchased to when it goes into trust will crystallise and capital gains tax will be due. Please therefore refer any such requests to a tax advisor before telling a client that the other property can go into the trust. So winding up the trust, what happens on first death? Well, on first death, when the first client in a couple dies, the house continues to be held in the trust and the survivor has normal occupation rights as defined in the will of the deceased or in a statement of wishes if that's different. Any bonds invested with the deceased as the sole life insured would have to be cashed in and either reinvested or distributed. If there's any specific wishes restricting access to capital or allowing access to capital, these should be clearly expressed in your instructions to ensure the trustees are aware of the wishes. On second death, bonds with the lives assured of the deceased clients are cashed. Bonds taken out on lives of children can continue and be assigned out to the beneficiaries. The process to cash in the bonds or transfer them takes 4 weeks once the signed paperwork is received by the life insurance company. The home can be sold or transferred to all of the beneficiaries, or even only transferred to one beneficiary if the other beneficiaries have come to an agreement. The cost of conveying the property to the new owners has to be met by them.